Welcome to this explainer. Okay, today we are going to dive straight into what I like to call the absolute fundamental law of gravity that governs literally all financial markets. And that is the time value of money. Whether we're talking about valuing a simple government bond, trying to figure out the real, true worth of a high-flying tech stock, or just hunting for risk-free profits, it all traces back to this one unifying concept. So, let's decode the mechanics of exactly how the market prices the future. But before we jump into the heavy math, let's just start with a super basic foundational question. This really puts us right in the mindset of how analysts actually value assets. Okay, would you rather have $10,000 placed right into your hands today, or a promise that you're going to get that exact same $10,000 exactly 1 year from now? I mean, intuitively, you want the cash today, right? And why is that? Well, because you could take that cash right now, invest it immediately, and earn a return over the next 12 months. Or, hey, you could just spend it and enjoy it today. That simple built-in human preference for immediate over delayed gratification, that's the beating heart of finance. So here's our roadmap for this explainer. First, we'll cover the time value of money. Then move on to pricing bonds and yields. Third, we'll look at valuing stocks and growth, followed by the cash flow additivity principle. And finally, we'll wrap up with real-world arbitrage applications. All right, let's jump right into Section 1, time value of money, the core principle. So the basic premise here is that cash today is always preferred to cash tomorrow. And the exact compensation you require to delay your payout, that's what establishes a baseline interest rate. Think about it like this. If you tell me that having $9,500 today is economically the exact same to you as having $10,000 in exactly 1 year, well, you've just revealed your required rate of return. That difference, $500, is literally your compensation for waiting. If we just divide that $500 by your initial $9,500, we get an interest rate of 5.26%. That rate is the bridge connecting present value to future value. And really, every financial asset out there is just a string of these future cash flows, all waiting to be discounted back to today. Moving right along to Section 2, pricing bonds and yields, fixed income fundamentals. When we want to value these fixed bond contracts, we use something called the yield to maturity, or YTM. You can think of YTM as kind of the great equalizer in finance. When a bond pays you, say, a mix of periodic coupons and then a big lump sum at the very end, the yield to maturity acts as this single, uniform discount rate that anchors every single one of those future payments. It essentially calculates an internal rate of return, but it assumes two really important things. First, that you're actually going to hold the bond until it fully matures, and second, that you can reinvest every single coupon payment you get along the way at that exact same rate. And this brilliantly illustrates how different bonds actually behave out in the wild over time. Because bonds don't just sit still, right? If you buy a discount bond, which just means you're paying less than the final principal amount because the market interest rate is currently higher than the bond's coupon, the price of your bond is naturally going to rise or accrete right up to its par value as it gets closer and closer to maturity. On the flip side, if you buy a premium bond where you're paying more upfront because its coupon is super attractive, well, that bond's price will slowly shrink or amortize back down to par over time. It's like the time value of money acts as gravity, constantly pulling the bond's price toward its final payout as the clock ticks down. Now, the math can get absolutely wild when market environments suddenly shift. Consider a 10-year German sovereign bond. Back in 2016, these things were actually issued with negative yields. Seriously, an investor was paying a premium, like 100.50 euros, just for the privilege of receiving 100 euros in 10 years. That's a negative yield of minus 0.05%. But then, fast forward 6 years, and inflation just skyrocketed. Suddenly, the market demanded a way higher return, so the price of this exact same bond plummeted down to 95.72 euros. So, if a new investor swooped in and bought that exact bond right then at a steep discount, their implied return for holding it over the remaining 4 years completely shifts into positive territory, yielding 1.10%. It's wild to think about, but the exact same asset with the exact same cash flows can suddenly offer a completely different implied return just because the present value changed. Let's step it up a bit in Section 3, valuing stocks and growth, the infinite horizon. Okay, so valuing a stock is a whole different beast because it requires us to make assumptions about how cash flows are going to behave, well, forever. The constant dividend growth model, for instance, assumes a mature, stable company is just going to increase its dividend at a steady, predictable rate indefinitely. But obviously that doesn't work for a booming startup, right? That's where the two-stage dividend growth model comes in. It brilliantly captures the modern life cycle of a company, mapping out an initial phase of explosive, rapid growth that then abruptly downshifts into a slower, constant growth phase once the company finally matures. To really break down the complex math of a multi-stage company, let's imagine a fictional firm called Shipline. I know it might seem super intimidating to calculate infinite, constantly shifting cash flows, but honestly, we just break it down into simple, bite-sized pieces. First, we just find the present value of the dividends during that initial short-term burst of high growth. Second, we calculate what the stock will actually be worth at the exact start of its mature phase, what we call the terminal value. And we discount that massive lump sum all the way back to today. And then, step 3, we literally just add those two present values together. That's the whole shebang. So, here is the absolute crucial takeaway. We can actually use these exact same models to reverse engineer the market's hidden expectations. Imagine Coca-Cola is trading at a forward price-to-earnings ratio of 28. If we know their dividend payout ratio is 70%, and we estimate that investors require a 6.5% return just to take on the risk of holding the stock, well, we can just work the algebra backwards. Doing the math tells us that the market is secretly pricing in an implied perpetual dividend growth rate of exactly 4.00%. The stock price you see on the screen isn't just some random number pulled out of thin air. It is a direct mathematical reflection of the market's collective bet on future growth. All right, moving into section 4, cash flow additivity principle, the golden rule. This is basically the aha moment of our explainer. The principle of cash flow additivity dictates that if you take absolutely any financial asset and break it down into its individual future cash payments, the total sum of their present values absolutely must equal the price of the whole asset today. You can slice and dice those cash flows however you want. You can package them together, strip them apart, but their total present value at any given moment in time is going to remain exactly identical. Let's look at how this builds a foundational rule of the market. Consider these two completely distinct investment strategies. On paper, Strategy 1 and Strategy 2 distribute cash in entirely different ways over 3 years. Strategy 1 pays you a steady £45 every single year. Strategy 2, on the other hand, gives you a big £60 up front, then drops to 40 and then down to 32.35. But here's the kicker. If you apply a 10% discount rate to both of those streams, they both equal exactly £100 today. And this mathematically guarantees the law of no arbitrage. If two entirely different investment strategies produce economically identical present values, they simply must cost the exact same amount today. Because think about it. If one costs £99 and the other cost £100, a trader could instantly buy the cheaper one, sell the expensive one, and boom, create a risk-free money glitch. The market algorithm instantly corrects these imbalances. And that brings us to our final section, Section 5, Real-World Arbitrage Applications. Because the market is constantly aggressively hunting down and correcting these risk-free profits, we can actually use this assumption of cash flow additivity to determine fair prices for things that haven't even happened yet. Wall Street analysts use it to mathematically lock in implied forward interest rates, to determine forward global currency exchange rates, and even to price those incredibly complex, multi-layered options contracts. Let me show you just how clever this gets when we look at implied forward rates. Imagine a 2-year risk-free bond yields 3.5%, and a 1-year bond yields 2.5%. An investor could just buy the 2-year bond, right? Or they could buy the 1-year bond and then roll that money into a brand new 1-year bond next year. Well, because of the law of additivity, those two strategies absolutely must result in the exact same final payout. Therefore, we can use algebra to mathematically deduce the hidden 1-year forward rate, the rate expected exactly 1 year from now. Doing the math here, the market is implicitly telling us that the hidden 1-year forward rate is exactly 4.51%. If the actual rate out in the real world ends up being different, arbitrators are going to exploit it ruthlessly until equilibrium is completely restored. And we use this exact same logic to spot massive mispricings in the stock market too. If we analyze Coca-Cola's fundamentals, like the required return and expected growth, the math might plainly tell us their fair value price-to-earnings ratio should be 15.56. But wait, what if you look at the screen and the stock is actually trading on the open market at a PE of 28? When prices drift that far away from what the fundamental math dictates, it violently violates the expected cash flow rules. Savvy investors are going to spot this massive disconnect, identify it as a deeply overvalued asset, and potentially short the stock, essentially betting that the iron laws of valuation will eventually force that price to crash right back down to reality. We even apply this additivity magic to binomial option pricing. Suppose a stock in China is currently trading at 40 yuan. Next period, let's say it has a chance to jump up to 56 or completely crash down to 32. If you want to buy a contract today that gives you the right to buy that stock at 50 yuan next period, how on earth do you price that right now? Well, you do it by breaking down the future probability tree into discrete cash flows and ensuring that the present value of the option contract strictly adheres to cash flow additivity alongside a risk-free bond. It all comes right back to equating those future cash flows to present realities. So, we've seen how the time value of money truly acts as the escapable gravity for the entire financial universe. It governs literally everything from sovereign bonds to infinite dividend streams. But understanding that the market mathematically enforces this strict no-arbitrage rule leaves us with one incredibly provocative thought to ponder. The math is perfect, but human emotions? They definitely are not. So, where is the market currently getting the math wrong right now? And what hidden opportunities are just waiting for you to do the calculations? Thank you so much for joining me on this explainer, and definitely keep your eyes peeled for the math hiding in plain sight.